Using advanced strategies to get options premium to work in your favor and creating ranges for which the stock to trade in is actually logically and I guess statistically better for your overall portfolio. Although it is going to take a lot more buying power to create just a little bit less of the reward, right? So it's going to be not really high risk if you're managing it, but it's going to take a lot more money to make a lot less, but your probabilities are going to increase. And also, you're going to have time on your favor. In our previous videos, we discussed iron condors, and we also have a video about managing iron condors as well. But in this video, we're going to discuss something called an iron fly. Now, how do you make up an iron fly, and why would you want to do this? And what are the benefits of actually putting on an iron fly compared to an iron condor? Now, right here on our Netflix, we have our May 30th expiration up right now. And this is a setup for an iron fly here. So you can see as a normal iron condor, we would probably go something like this. So you have your short strikes out here. And then if you go about $5 out, this would be considered a $5 wide iron condor, is what this would be called. Your wings would be about $5 away from your short strikes here, and that's where your long strikes are going to be. So the 1165, you're short the 1175, you're short the 1200 on the calls, and you're buying the 1205 calls. But if we were going to create an iron fly, you're actually going to sell the premium here on the put and the call side at the same exact strike. So you're selling the 1185 call, and you're also selling the 1185 put. And then this is going to be considered a $20 wide iron fly. We're going to go $20 down here in the puts to 1165 here. We're buying this 1165 put, and then we're going $25 up. We're buying this 1205 call. So what we did is actually we tightened the range, right? So whereas the iron condor, you can see how your range gets a little bit wider here with your break evens and things like that. Well, actually, we're tightening this range, and the max profit actually increased, and we're receiving more credit, but we're putting up less buying power. So if we go back again to that $5 wide iron condor in here, you can see that, our max profit's going to be 316, max loss is going to be 185. And that's if Netflix stays trading in between here. But if we go here, back to the iron fly at the 1185 $20 wide, our max profit is now $1,500, and our max loss is only going to be $400. But the problem is that means the stock needs to end up exactly at 1185 or so, or stay where it's currently at, to realize this max profit. So you're not actually ever going to collect the max profit on an iron fly unless the stock stays literally exactly the same. But the reasons that we would want to do this is because we have a chance of making more profit using less money, and we have a lot more theta on our side. Whereas an iron condor, you would have a little less theta on our side, and our delta would be skewed a little bit. Whereas this, our delta is basically neutral. So here, the range has decreased a little bit, and we do need the stock to go exactly right here to realize this max profit. But if we're managing this every hour, every half an hour throughout the day, we're doing a 0 DTE, or doing a 1 day, or even if it's a weekly, right? And here, we are still going to be managing this very aggressively, and actually trying to close this out as quick as possible. So you would not put up this $400 to create the full 1,500. I just said I'm going to leave it until I make the full 1,500. No, you wouldn't do that. You deploy this and then let the stock kind of dance around here for about 20, 30 minutes, and then go back and check it and see where you're at. If you're down 50, or if you can buy it back for 50 cents cheaper, a dollar cheaper, then go right ahead. You just made $50 to $100 in about, I don't know, 15, 20 minutes, 30 minutes, doing basically nothing, right? And you actually had time in your favor. So that's why you want to deploy this. Your probability of profit is going to decrease by doing this, because here you're saying that our range is tightened for our break even, but you're basically saying overall, I want the stock to trade here. Whereas an iron condor, you're creating a bigger range, as you can see here. And then the probability of profit obviously increases. So that's why you would want to deploy an iron fly, and what the differences are between this and an iron condor. Again, this is going to be, you technically do have a good chance of making a lot of money in this, but again, the stock has to stay the same. So even if you get a big downtick here and you think it's going to go back up, you can leave it the same. But really, people just put these on here for about 15, 20, 30 minutes, take off their, 40, 50 cents, dollar, whatever, and then get out. That's how you'd want to actually want to play these. You want to manage these pretty aggressively because the stock is never going to stay exactly right here in the same spot. So that is a good example here of an iron condor, or I'm sorry, an iron fly. Just think of it as an iron condor, only guess what? Your shorts are going to be at the same exact strike on here. So hopefully this helped. Hopefully this makes sense. And we will go from there. All right, guys, make sure to check us out on all of our social media. We also have a Discord service if you're interested, and you can find all of our socials in the description below.